Thank you for joining us. Just a couple of notes before we begin. We are recording this session, and if you have any questions during the webinar, please raise your hand or type your question in the Q&A box. Um, Welcome to this NGen webinar on insurance considerations for advanced manufacturing and emerging tech companies. It is my pleasure to introduce you to our speakers from Access Insurance. We have with us today Chris Jones, Clive Bird, and Tristan Smith. Clive is the Senior VP of Mining and Technology at Access. Clive specializes in structuring bespoke insurance solutions for high growth and technically complex companies. Drawing on a Lloyd's of London background and decades of brokerage experience, he works with clients facing complex technology, IP, regulatory, cross-border, and transactional risks. Chris is a senior account executive of mining and technology at Access. Chris brings nearly 2 decades of insurance industry experience specializing in complex and emerging risks affecting technology and advanced manufacturing companies, including IP, cyber, robotics, automation, and AI. He has a strong technical background and deep understanding of contracts and insurance policy language, with a focus on structuring bespoke risk and insurance solutions for scaling and innovative businesses. Tristan is a risk specialist focused on mining and technology at Access. With more than a decade of experience in technology ventures, he helps technically complex organizations connect with Access's specialized risk advisory and insurance capabilities. With that, I'll pass it over to Access.
Hello, everyone, and thank you to NGen for the opportunity to be here. Advanced manufacturing companies are operating in an environment that looks very different than it did 10 years ago. Software, automation, AI, robotics, cloud platforms, and third-party technology providers are increasingly embedded within operations. These technologies create tremendous opportunities for growth and scalability, but they also change how risk develops and how losses occur. So today we'd like to discuss how risk changes as companies scale, why modern losses are becoming more complex, where companies are commonly surprised, and what leading organizations are doing differently to improve resilience and their insurance outcomes. So one of the mistakes we frequently see is organizations starting with insurance. So insurance should never be the starting point. Instead, we begin by understanding the business itself. So what products or services are being delivered? What environments are they deployed into? Who depends on them? The commitments made to customers? What dependencies exist across the vendor and supply chain? And what controls exist internally? Only after we understand those factors can we determine what risk remains. Insurance sits at the end of that process, not the beginning. In our view, the strongest outcomes occur when operations, contracts, controls, and insurance are aligned. So modern manufacturing environments are increasingly interconnected. Software drives production, automation controls workflows, cloud platforms control critical processes. We increasingly rely on suppliers, technology vendors, and outside infrastructure. Customer relationships are increasingly governed by contractual commitments and performance obligations. The result is an operating environment where software, operations, suppliers, customers, and cloud infrastructure are all connected. Now that's important because disruptions are rarely isolated. Instead, they often impact multiple areas of the business simultaneously. Many businesses focus on what causes a loss. We believe the more important question is what determines the severity of a loss. Now, there's 3 factors that we consistently see emerge. The first is third-party dependency. The second is interconnected systems. And the third is contractual amplification. A software failure, cyber event, or vendor outage may be relatively manageable on its own, but what drives severity is how that event spreads through operational dependencies, interconnected systems, and contractual obligations. One of the most important observations is that strong controls do not simply prevent losses. Strong controls prevent losses from spreading. Vendor management reduces dependency risk, network segmentation limits the spread of cyber events, and business continuity planning helps contain operational disruption. We find that the companies that achieve the best outcomes are often not the ones that avoid every incident. They're the ones that prevent incidents from spreading. So this example illustrates how a relatively contained event can become a major loss. So the software compromise is not necessarily the problem. The problem is everything that follows. Manufacturing systems are impacted, production stops. Sorry about that. I'll just start from the top for this one. So many businesses focus on what causes a loss. We believe the more important question is what determines the severity of a loss. Okay, so manufacturing systems are impacted, production stops, customers are affected, contractual obligations are triggered, and financial loss follows. The severity is determined by how far the disruption spreads. And this is why resilience matters. Strong controls help interrupt the cascade before it reaches customers, contracts, and ultimately the balance sheet. Slide 6. Okay, so this is where insurance becomes relevant. Many insurance structures were developed for a time where losses were more isolated and easier to categorize. But today, a single event may disrupt operations, revenue, cause physical damage, trigger contractual liability and customer claims, and cause cyber-related costs simultaneously. The impact is that this requires multiple policies to respond to the same loss. But the challenge is that insurance policies often respond based on how the loss originated rather than how the loss ultimately impacts the business. It then becomes a question of whether multiple policies, the entire insurance program, is correctly aligned to respond to the single cause of loss. The strongest outcomes occur when controls, contracts, and insurance are aligned before a loss occurs. Okay, so we find that many businesses get into trouble because they underestimate where risk accumulates. One common example is third-party dependency. A vendor outage can create significant downstream liability. Another is cyber risk. Cyber events increasingly create operational disruption rather than simply data breaches, as illustrated on the previous slide. A third area is intellectual property. As companies move from pilot projects to commercialization, their visibility increases. New customers, new markets, and new competitors create more opportunities for allegations that a product, process, or a manufacturing method infringes on someone else's rights. Now, many organizations assume this is only relevant if they own patents, but in reality, virtually every commercial agreement contains some form of intellectual property indemnity. So the exposure is present. The question becomes how severe it could become. We also frequently see organizations accepting contractual liabilities that exceed what can realistically be insured. We find that these obligations are often accepted during contract negotiations long before anyone asks whether the insurance program can actually support it. So the strongest organizations don't simply transfer their risk, they understand it. So they identify critical dependencies, they evaluate their contractual obligations, they align their cybersecurity with operational resilience, and they actively manage insurer perception. Most importantly, they build controls designed to prevent disruption from spreading. The objective is not simply to respond effectively, it's to prevent a manageable event from becoming a major loss. So this is the process we've developed to help companies address these challenges. And everything starts with visibility. So understanding the exposures, identifying the weaknesses, and prioritizing risk. From there, we help improve controls, align contracts and insurance, strengthen resilience, and improve insurer positioning. The objective isn't just insurance placement, it's reducing disruption and improving long-term outcomes. So the foundation of that process is our risk compass assessment. Many organizations already know some of their challenges, but what they often lack is a structured way to identify which issues create the greatest downstream impact. So the compass evaluates operational, contractual, cyber, intellectual property, governance, and resilience exposures. The goal is visibility, a roadmap for improvement, and an underwriting ready narrative that demonstrates risk maturity to underwriters. So, one of the most important concepts we discuss with clients is that growth changes risk faster than most organizations update their controls. The controls that were appropriate during a pilot phase may not be appropriate during commercialization. And the contractual obligations accepted during commercialization may not be appropriate once enterprise customers become involved. As companies scale, insurers increasingly evaluate the resilience, continuity planning, cybersecurity maturity, contractual obligations, critical dependencies, and recovery capabilities of the business. Strong controls create considerable value when insurers understand them. One of the most common mistakes that we see is organizations investing heavily in controls but failing to communicate those improvements effectively to their insurers. Most organizations approach insurance as an annual transaction. An application is completed, submission is sent, premium is negotiated, but insurers increasingly are looking beyond the application itself. They're now evaluating preparedness, the governance, the operational maturity, and the resilience of the business. And we find that the quality of the underwriting narrative has a direct impact on insurer engagement, coverage breadth, and long-term market support. So every advanced manufacturing company is different, whether it's different technologies or different customers, different contracts, different deployment environments, or different dependencies. And this is why we don't believe in industry standard insurance programs. For example, two robotics companies can have completely different risk profiles, and each requires a solution tailored to its operations. Axis is also a Canadian-owned brokerage. We operate from coast to coast, and we're not a branch office of a US-based parent. The advice, strategy, and market placements are handled locally by people who understand the Canadian market and the challenges facing Canadian businesses. So if there are 5 things to remember from today's presentation, they are that technology risk is operational risk, dependencies drive loss severity, contracts amplify consequences, and growth changes risk profiles. Insurance follows operational maturity. The organizations that understand these relationships tend to experience fewer surprises, stronger resilience, and have better long-term outcomes. So the good news is that most disruptive losses are not caused by a complete lack of awareness. but they're caused by assumptions that have never been tested. And that's assumptions about vendors, about their contracts, about their recovery capability, and about insurance. The first step is understanding exposure. The second is validating assumptions. The third is strengthening resilience. And the fourth is positioning for growth. The organizations that do this well generally experience fewer disruptive claims, stronger insurer confidence, and better long-term outcomes. So I'll leave you with one final thought. The organizations that scale most successfully are not those that avoid every disruption. They are those that understand their risk before disruption occurs. Technology is creating tremendous opportunity, but it's also changing how losses develop, how organizations scale, and how insurers evaluate risk. Risk control is increasingly becoming a competitive advantage. So thank you again for your time, and we'd be happy to address any questions.
Sharon, are there any questions at this time?
I don't see any in the Q&A box, but I do have a question. So, many of our companies are busy running their business. So, where do they start? And they probably likely have uh, at least some insurance in place. So, how do they go about, making the assessment, and making sure that they can beef up their policy when it's necessary?
So I think the first place to start is by engaging Chris and I in a conversation, and we are easily reachable. We're always available. And for myself, I can be reached 24/7. I will take a call anytime, day or night. The second point I would say is that our risk assessment has been designed to be incredibly user friendly. And for NGen, there is absolutely no cost for an NGen member to use our risk assessment. And we've designed it as a self-assessment. And that is not to say that we're not interested in how the clients go about assessing their own risk, but it's to develop the members' own perception of their risk, so we can see where their thinking is. It's a assessment that takes about an hour to complete. So there's an investment in time. There's no cost to do it. You can do it in your own time when you want to, and you will immediately get a report once it's done. We will also get a copy of that report, and we will then look at those risk controls and see where they're weak and provide practical guidance. We have a process in place to immediately respond to that risk assessment involving dialogue. And that is our first step before we start talking to people about piling on insurance. We want to understand where the company is positioned in its corporate development, what its growth plans are, and we will want to work together to structure a program that is going to grow with your member rather than just adding on policy after policy. So that's our approach. It's very simple. We would ordinarily want to look at the existing coverage. We will consult on that coverage, discuss areas where there might be weaknesses or where they're maybe not compatible with the risk profile of the company. Chris, anything to add to that?
Yeah, the only thing I'd add is that we also take a deep dive into the contract. So the contractual environment in which each customer is operating under, vendor contracts, supplier contracts, customer contracts, all of that becomes very relevant to our review.
Mm-hmm. Yeah, I mean, in my experience, I think a lot of companies don't often read contracts carefully when they sign, or they don't remember what they agreed to. They signed a contract a couple of years ago, they don't remember what the clauses were. So I think that's important. So we do have a question here. There was a slide dedicated to showing the differences between a typical insurance policy assessment and the access method. Can you go a little deeper into the shortfalls of a typical insurance assessment?
Do you want to take that one, Chris?
Yeah, Tristan, do you want to just pull up that slide so we can take a look?
Yeah, for sure.
But I think ultimately this is just to echo what Clive was saying about our online self-assessment. Everything that we just touched upon, the contract review, the risk compass, and developing that underwriting narrative, utilizing all that information that we gleaned, and also providing resources to allow the customer to improve their internal controls before we approach underwriters. All of that goes into the underwriting narrative that we present to the market. So I think that's what the difference is.
And then we have another question. Do you provide the risk assessment for technology companies? So I think that's getting at so the assessment is not only for manufacturing companies, it's for any company, right? Any technology company across the board.
Yes, absolutely. So it was originally designed for technology-driven companies, but we found that advanced manufacturing companies that are deploying technology within their processes will benefit tremendously from it. It touches on 8 areas of risk, all of which are relevant to advanced manufacturing companies as well as technology-driven companies, whether it's a robotics company, a software company. All of the sections will be relevant to the discussion.
If there's nothing else, I think we can wrap up early. Any last comments? Clive,
Sharon,
Tristan? Mm-hmm.
yeah, Sharon, just one thing I wanted to mention. Chris mentioned that we are a Canadian company. We're proud to be a Canadian company. And we have offices coast to coast, as you mentioned. I would like to add that we have clients with operations all around the globe, Africa, Asia, Australia. We also have international clients that are head officed overseas. So our international capabilities, our relationships internationally are incredibly robust. So I just didn't want anybody to think that we're limited to Canadian-only exposures. We can work with your clients regardless of where they are involved in the world. That was probably all I wanted to bring up at this point.
Yeah, good point. And we will work with our team to get the risk assessment into the hands of our NGen members so they can start looking at their own company and doing the assessment to see where the gaps are. So I think that would be a good starting point for our members.
Absolutely.
Yeah.
Awesome.
Fantastic.
Okay. If there's nothing else, then well, thank you so much. That was very informative, and yeah, have a good rest of your day.
Thank you very much, Sharon.
Cool. Thank you very much.
Thank you.
Thank you
Bye.
for your time.
Bye.
Have a great day.